to yet another interesting session. And I can promise you this would be something that would really interest you. As as a ritual from Edelweiss, we've always been coming across with something which is new, which is exciting, and continuing with the trend today also. We would take you through a product idea, which is known as an Edelweiss Discovery Fund. It is a Category 2 AIF product, and the details of this product would be discussed by none other than the guy Ashish Agarwal, who is the fund manager of the scheme. And just to speak about a bit about Ashish, more than 20 years of experience. He's been doing more than 15 years has been doing private equity. His previous experience has been working 15 years at Nevis Capital, and he would be the individual who would run the show for us for this product. So now I'll before I hand it over to Ashish. I would also ask everybody to make sure that they put in their questions in the chat box. We'll make sure that we'll take as many questions as possible at the end of the session. Ashish, please take it forward.
Thanks, Paras, and thank you everyone for joining in. I'm just going to spend the next better part of the next half an hour just first describing to you the product, and then I'd be very happy to take your questions after that. So just as context, Discovery Fund is a mid-stage private equity fund. And let me start speaking through exactly what that means. Essentially, if you look at a business's trajectory from start to IPO, I have essentially segregated them into 3 different stages. All of the initial stages at the pre-seed level, or the seed funding, or what is called as Series A, the first institutional funding, are all in a stage of business where the business is still in nascent times. The revenues haven't scaled up as much. You probably have an idea, or you have an idea with few customers, some revenues, but the sustainability of the business is still a reasonable question mark. By the time you get to mid-stage funding, that becomes a lot more established. It takes a few years to get there. We consider mid-stage as companies which have at least 50 crores in revenues. So to be able to get to that stage, you then have several customers. You're reasonably established, and it's at that point where we think that there's enough material that one can diligence about these companies, and therefore they become investable from our perspective. Which is very different from first, the late stage, where the risk-reward profile is quite different. And just on that point, let me share with you what the risk-reward profile is for these 3 different stages. So in the early stage, of course, these companies are growing often more than doubling every year, because it's from a very small base. But there is also very high failure risk. And therefore, the way to create portfolios when investing in early stage would only be by having very large portfolios where you have 60, 80 names. Many of them won't work out, but the few that do will do so well for you that they make up for the ones that don't. Also, this has become a very crowded space. Earlier, it was only VCs and family offices, but now aggregated angel networks have become extremely relevant, and therefore the competitive intensity in this space has also increased a lot. Compared to that, I find mid-stage very compelling, because the risk-reward ratio is a lot more balanced. By the time a company reaches that 50 crore in overall revenue, the failure rate reduces to below 10%. And that then can be further mitigated by due diligence that we do on the companies that we want to invest in. And in that sense, the balance of getting a 25 to 30% operating growth at a low failure rate zone is a very compelling proposition. Can I just request others to go on mute? Yeah. And then if you contrast that with late stage, the growth rate becomes lower. Of course, the failure rate is also lower than what it is at the mid stage. But again, this space is very competitive with large global Ps as well as domestic Ps. And the domestic Ps is very relevant because a lot of the mid stage investors in India, with their success, have been able to raise more capital. And have become now more late stage in nature because their check sizes are now larger. And therefore, that space has also become very competitive. Now, when I speak of more competitive, it's only in a relative sense. Of course, in the unlisted space, everything is competitive. But I'm just making the point that both early and late, the competitive intensity is a lot higher. Now, the product that we have put together is will essentially invest in companies that are between 50 to 300 crores in revenue at the time of investment. And that defines that mid-stage that I've been describing. The most important element about what we're doing is we're only focusing on companies that have strong unit economics. A lot of the startups that we come across are, in my mind, structural cash burners, as in they will burn cash for a very, very long period of time because the nature of the business that they're in requires them to reach a certain threshold market share, and only then can that business seek to exist and dominate, of course. But to get to that market share threshold, you need to burn through several years of cash. And that's not something that a business model that I'm very comfortable with. I much more prefer businesses where you can have strong gross margins. You might not have EBITDA at the time of our investment because the entrepreneur has to invest behind, say, marketing or building a team. But the path to profitability is pretty clear and imminent. And these are very important criteria in Discovery's selection of companies that we are investing in. In terms of sectors, it's a sector agnostic fund, but we like consumer brands. We like, in some cases, specialized retail. And we also like a whole host of tech-enabled B2B businesses. I'll run through some specific examples of the one investment that we have recently announced and others which are in our pipeline as well. And in terms of the overall portfolio, we're looking to essentially invest between 50 to 150 crores in each company. Most of our investments in the beginning would be 50 to 80, so that there's enough room to do a follow-on if we want to within these investments. We're looking to have 12 to 15 investee companies in the portfolio. All of these will be minority stake investments. Typically, our stake will be between 5 to 20%. Importantly, I focus a lot on the documentation. So the kind of contractual rights that we have are going to be very strong in terms of ensuring we have both the ability to manage how the business is being grown, so long as it is growing along the lines of what has been described to us. We have an ability to influence if it's going materially off the rails in any situation. Now let me get to explaining a little bit more on why I like this mid-stage space a lot. And why I think Discovery, is a good fit for many investor portfolios. The first point is it gives you access to an attractive pool of companies that aren't discovered as yet. Right? So when I speak of consumer brands, these are not brands of the size of a Licious or something which you have already seen at a pan-national level. Because those companies have already become larger than the 300 crore kind of threshold. What you'll get access to are the next set of companies that have the potential to become those large companies. And I think that's a very attractive set to be invested in. Then I'll share two pieces of analytics with you. One which makes the point that overall the mid-stage has delivered a 30% median growth rate for the last few years. And the second, which is an important point, is that the valuation multiple that one pays at the mid-stage versus in late stage has a real gap in it, which effectively provides me a hedge against macro volatility at exit. And I'll explain this with the analysis that I intend to share with you. And finally, that as a team, this is what we've done. All my investments over the last 15 plus years have all been in mid-stage PE. So let me go through the two pieces of analysis that I was referring to. The first is a relatively simple one. We have simply just looked at all companies in FY17 and FY18, which raised a round of mid-stage private equity, right? So 75 to 150 crore kind of a fundraise. And we looked at across these 150 plus companies, what has been their operating growth since that investment. The median of that has been in excess of 30%. The second piece, which is the one around valuation, is an interesting one and worth your attention. We looked at all the IPOs last year and then went back in time to check when they had raised a mid-stage round, what was the valuation at that stage versus what has been the valuation that they got at the time of an IPO. Right? So if you were to take an example, say of Nykaa, the first one, in the mid-stage, it got 3 times price to sales. At IPO, it got 22 times price to sales. Right? With the listing day gains, that number shot up to 43 times. Right? But the story doesn't end there, because we all know that a lot of the IPOs of new economy ideas last year have severely corrected since. So if you look at the current P bias, this is based on a recent share price, then that number drops down to 12x. And if you look at the median characteristics of this data set, essentially what you're seeing is that when the deal pricing was at the mid stage, that was at 4 times price to sales, which goes up to 15 to 20 times at the time of the IPO. But during adverse macro factors, when interest rates are increasing, there is inflation, there's a war happening, and all of the other macro factors that we are all aware of, then the median pricing is 9x price to sales. The takeaway from this is really that late stage, during good and bad times, the valuations tend to fluctuate, as is shown by this data set, from 10 to 20 times price to sales. Whereas for the mid-stage transactions, if you were to look at the transactions that were done in 2021, that median of 4x had increased to 6x. So at one stage, there's an opportunity to exit in these, to enter in these companies between 4 to 6x and exit hopefully in excess of 9 or 10 times price to sales. That really is a very powerful multiplier of returns. And I'll share some case studies with you to show the impact of that. The third point around mid-stage private equity is that it gives you several exit avenues, some of which are not as available in the late stage. So, for example, if you had to sell to a strategic, and a lot of Indian strategics have become very, very active. This morning was an article around Hindustan Levers acquiring 2 businesses. Earlier, we've seen the likes of Marico, Dabur, ITC, all becoming very, very active acquiring brands. They acquire these brands when they are a 300, 500 crore brand, not when they become a 3,000-4,000 crore brand. So if you have invested in a mid-stage company that in your exit horizon gets to that 300 to 500 kind of number, that's when you have the option of having these attractive strategic transactions as a way of exit. The second piece, of course, is the secondary market. A lot of late-stage financial sponsors are keen to find place in these cap tables to enter into these companies, and they represent a potential exit avenue as well. And of course, if it gets to an IPO, that's the third exit avenue that's available. Now, let me take you through the case studies that I had mentioned. The first one is Nykaa. And I've put on this page essentially all the different rounds of capital that Nykaa had raised with the valuation and the deal size at each of these rounds. Now, if you notice, the kind of investments Discovery is going to make is essentially going to fall as Series B, Series C investments. That's the $10 to $12 million, or broadly that 80 to 120 kind of range. And there are 2 aspects I'd highlight to you using this case study. The first is the number of times that an investor potentially has to find an exit opportunity. It's almost every 12 to 18 months that these companies are raising a subsequent round. And there's a potential for you as an investor to say that I'm now seeking a secondary, and therefore I look for an exit rather than participating in that round. The second, which is the bigger point, is the multiplier effect of the growth from mid to late stage on valuation. So during a period of 18 to 21, when revenues increased by 4x, valuations increased by a very large amount, 22x. And one could theoretically argue that a lot of that value unlocking happened at the IPO, but you will see that that's not necessarily the case. If you take an example of a company like Licious, which is still unlisted, again, the Series B, Series C represents that $10 to $20 million mid-stage private equity zone. And you'll see that the same two factors are applicable. One is that you have an exit avenue that comes up almost every 1 to 2 years. And the second is that as Licious grew and revenues increased by 5x over a period of time, the valuation increased by 35x over that same period of time. Right? And so the value unlocking is not happening just at the IPO. It's essentially happening as the brand becomes a lot larger. One, the failure rate associated with it reduces. Two, the competitive intensity of late stage is really what drives up valuations for these brands, because a lot of investors would like to participate in these stories. Now, with that, let me get into investment themes of what we like and don't like and what are the spaces we're looking to invest in. So consumption is a big one for obvious reasons. Across, whether it's food, education, health, all of those are spaces that we are looking at. Specialized retail is a second space that we like. And as I mentioned, B2B disruptors is a third one. All of the investments that we would look to do would be essentially asset-light businesses, more new economy ideas. I'm looking to invest behind category creators and not necessarily go after businesses which have large listed peers. On the negative list, the one I'll really focus on is the unit economics. And I'd made that point earlier as well. If a company has low gross margins as a consumer brand, for example, then that becomes straight away the reason for us to walk away from that transaction. Let me share with you some examples of what is in the imminent pipeline and what has recently been announced. So Project Radiant, as it refers to here, is a company called Rene Cosmetics. This is a company we invested and announced just earlier this week. It's a cosmetics brand based out of Ahmedabad. It is one of the fastest growing companies, one of the fastest growing startups overall, and the fastest within this category. They've scaled from 0 to over 100 crores in revenues, literally in the first 20 months of their operations. One of the things I liked about this business is that they're not a Me Too player. They've essentially done packaging form innovation in terms of being able to have different shades of a lipstick in one stick and then have different products all in one stick. And that has really helped them have the kind of sales momentum that they have delivered. Another aspect I really like about Rene is the entrepreneurial team. Both Ashutosh and Priyank are successful serial entrepreneurs. They had built Beardo earlier and sold it to Marico. They had built Villain, which is a men's perfume brand, and sold it to Mensa. So it's a very proven team. They have a playbook ready of how to build a brand, and essentially the capital is going to be used for that. As I mentioned, a high focus on strong unit economics. It's a very high gross margin business. They expect to turn EBITDA positive within the next 24 months. And so that's a brand like this will potentially find a lot of interest, both from strategics and financials as it becomes a large brand. The other investment I'll talk about, this is not completed as yet, so I can't share the name, but it's essentially an enterprise healthcare company that is focused on providing solutions both for pharmaceutical companies as well as hospitals. And it's not just hospitals, also diagnostic players. Their products is different, of course, for the different sets of customers. For the pharmaceutical companies, they have a doctor CRMO product, which essentially helps these companies to virtually connect with a large pool of doctors and disseminate information which is contextual, which helps their MRs become more effective in their sales process. And they have delivered fantastic results for their customers, where customers have been able to reduce their MR workforce but increase the kind of effectiveness of their sales force. On the side of providers, what this company does is has a patient CRMO where they're essentially able to work through the life cycle of a patient and ensure that access to information, a proper workflow in terms of knowing when the patient has to do what is made available very easily to the patient. So that's kind of the second investment we're looking at. This is also a very, very high growth companies. Being an enterprise SaaS company, it has very high operating leverage. So the swing to EBITDA breakeven can be very quick once it continues to scale up at the rate as it's going. And again, this is a space where there is a lot of strategic interest. So there's been a lot of interest purchasing enterprise SaaS companies, and so exit options will be available at the time of our exit. Beyond that, we have a pipeline of 5 other companies that we're looking at. The first one here, the consumer brand reference is of course to Rene, and this is no longer in due diligence. This is now completed. The second one we expect to announce within the next 15 days. And then we will continue to invest at that rate of 1 to 2 investments every quarter. There is a big pipeline we're working through, and there's a pipeline beyond these names of companies as well. So this is a great time to be launching this product, just in terms of the amount of investment options that are attractive and available. I'll speak a bit on our investment process. Origination is something that really is a differentiated approach for us. We don't depend just on investment bankers coming and showing us deals. We do a lot of proactive work in mining our own deals. For example, we've identified 5 or 6 different thematics where we have gone about mapping the market on who's doing what, and then going and meeting entrepreneurs to try and carve out a deal for ourselves. We also do a lot of screener-based searches of companies that have raised a certain amount of capital, say in the last 2 years, and then go through a very large, long list of those companies to identify which are the top 100 that resonate for us. We look at some of the portfolios of early stage investors and kind of see which are the companies that could potentially be interesting from there. So there are different ways in which we approach the origination effort. In terms of the execution, of course, our due diligence covers accounting and tax from a Big Four, covers legal due diligence from a top-tier law firm. And then we do commercial sometimes ourselves, and sometimes we take external help as well as needed. There is a very, very strong focus on background checks and making sure the company has strong corporate governance. That's a cornerstone for what we do. And then finally, after investing, we work very actively with these companies in areas that we can help on, for example, the overall business strategy. If there are bolt-on acquisitions that they're interested in, we know how to buy and sell companies and do transactions. So that's an area we get very involved in. If they have to hire a CFO, for example, these are spaces that we tend to get very actively involved in helping our investing companies. So that's broadly the investment process. And in terms of fund features, it's a 5-year product. So from the final close, which we expect to be in second half of calendar year 23, the fund will have a 5-year life and an option to extend it by 12 months, subject to majority investor approval. And the management fee would be 2% of the commitment of the committed amount. Sorry, the management fee is 2% of the drawn down amount. And the performance fee would be 20% over a hurdle rate of 10%. So that's pretty much the terms, the key terms of the product. In terms of taxation, taxation is a pass through to the investors, and it's a 20% for long-term capital gain on unlisted, long-term being over a 2-year hold period, which would be the case for all of Discovery's investments. So let me pause there and I'll take your questions.
Ashish, so till the questions get piled up, let me just in the interest of everybody, ask you a few questions. So now, first of all, if you could elaborate more on your experience, in terms of what were the kind of deals that you've done in the past, and what has been the results of those deals.
Yeah, sure. So so far in my investment tenure, I've put in $300 million to work. And that has generated an IRR of 20% and a MOIC of 2.7x. Note that these are dollar returns. I was investing in a foreign fund, and it was during a time where the rupee has gone from 45 to where it is today. And so the rupee returns for these investments were higher than the dollar return. So that's in terms of previous track record. The kind of investments, all of those companies were between 50 to 300 crores at the time of investment. They were all companies they were very actively involved in. In fact, those were all buyout investments. So we were more than 51% shareholder, and we had majority of the board in those investments. And therefore, the involvement also was very, very high. In terms of sectors, covered all the sectors, already invested in all the sectors that I mentioned, which are all around the same consumption theme: consumer brands, food, healthcare, light industrials. These are all the spaces that I've invested in the past.
Thanks, Ashish. Since you highlighted that this product, Edelweiss Discovery Fund, is essentially looking at mid-stage investing.
Yeah.
So now if you could once again clarify that, what do we mean by mid-stage? How do we how do a client here understand that for the scope of this product, what a mid-stage company would be like?
So I think there are 2-3 points that I can elaborate with respect to this. One is we are not investing in startups, right? Because investing in startups by definition means the element of risk is high. And this is why people who do angel investments don't do one or two, they create very large portfolios. We are investing in companies that have already established themselves to some degree, right? And my proxy of a minimum 50 crores in revenue is to establish that you at least are making close to 4.5-5 CR in monthly revenues to be able to become part of Discovery's universe. The other thing which we are not is we are not a pre-IPO fund, right? So we are not investing thinking that 12 से 18 महीने में IPO आना चाहिए. We are simply trying to find companies that have shown enough promise to reach that 50 CR threshold, but then try to come in early enough that the juice of growth is something that we can take advantage of. So that is really what I defined as mid-stage.
So continuing on that, are we looking at any seed or early stage companies here? Any emerging businesses?
No, we will not be doing any seed or early stage. We will typically be Series B, Series C investors. Sometimes we could also be Series A investors, essentially companies that have become quite large. I recently looked at a very interesting food company which is already 100 crores in revenue, but it hasn't raised any institutional capital so far, right? So in those circumstances, we could be Series A, but typically it's Series B, Series C invested.
Okay, and would these businesses be businesses essentially from India, or are we looking at businesses from outside as well?
No, all of our investments will only be in businesses which are domiciled in India. There are some businesses we came across which had presence in India, but they were domiciled outside India. We have taken a call to not consider those. It is going to be backing only Indian businesses. Now, of course, some of these businesses may have an export component. So they may be selling their product or service outside India. and many of them have global ambitions. But the businesses are Indian businesses run by Indian entrepreneurs.
So in the commentary, Ashish, you pointed out to unit economics be a very important indicator when we look at a company. Other than that, by anything that is very important, that we really look at from a business, since the tenure of the fund would only be 5 years.
Okay, so the one other point which we look at very closely is capital efficiency. Right, I want to only back entrepreneurs who treat investor money and VCP money as if it were their own money, right? So in terms of being very, very prudent in its usage, and that's something we focus a lot on during diligence. The overall point I'm trying to establish when I'm diligencing a company is, first of all, is this company here to stay? Is the capital secure? And then next part comes in terms of validating the growth story. So that's in terms of what else we look at. There was a reference to the tenure of the fund. Yes, I'm very cognizant of that 5-year tenure. The way I work around that is to ensure that in the documentation, we define the exit tenure. And there are specific clauses which give us the ability to gain additional rights to be able to achieve that exit. So the work for a exit starts as early as the 48th month of investment to be able to achieve it by the 68th month.
And do we have any preferences in terms of the businesses that we would consider for the scope of the portfolio of this product?
So I've partially already answered that question in the presentation. As I mentioned, we like consumer brands, so there will be a fair amount of those. And now consumer brands is very broad, right? It could be in several different categories, and that is the intent. Then we also like a lot of B2B tech businesses, and there are. I gave you the example of the enterprise SaaS business that we are looking to invest in soon, and there are others in the pipeline as well. And finally, we like specialized retail. But we are not confined to these 3 spaces only, right? We're a sector agnostic fund and we can look at anything. What we won't do is things like deep tech, Web 3.0, blockchain. And the simplistic reason for that is that I don't have sufficient experience in those spaces. And so I'll focus only on spaces that I have invested in the past and understand.
So Ashish, last few questions. And we'll wait if more questions come up.
Sure.
So you in your slide, 2 important points that you refer to with the data points from the past and how the valuations have moved.
Yeah.
In that, there was a reference to price to sales.
Right.
So how is that relevant when we look at private equity firms? Because that's something which people would want to understand, and that understanding would really help their decision making as well.
Sure. So let me first draw an analogy to the space where I think everyone does understand, which is public equities. There, when you speak of valuations, you typically speak of price to earnings. You speak of price to book. You do an EV to EBITDA. Now, for companies in the category that I'm describing, right, which are these 50 to 150, 200 crores in top line companies, most of these companies aren't profitable because at that stage is when they have to be investing behind their business. And if you're not profitable, you will not have an EBITDA or a earnings to base valuation on. Most of those companies are also quite asset light, right? And therefore a price to book would be the wrong way to kind of value these businesses on. And therefore, how do you value them? So you essentially look at what their current scale is. And you make a multiple on that. And that's the reference to the price to sales. This is why a lot of VC and mid-stage PE work on P by S basis. Of course, late stage pre-IPO, you start looking at the other 3 metrics that I described. I hope that clarifies.
No, very much, Ashish. Thank you so much. There's a question, and somebody would want to understand that how important is the credibility of an entrepreneur when you evaluate any business idea?
It's extremely important. we focus a lot on and I'll expand the credibility bit. It's across both competence and integrity. I think the numbers of the business and our conversations with them give us a lot of visibility on competence. And we focus a lot on, as I mentioned, background checks to also establish reputation, integrity, their dealings in the past. So this is paramount for us, because ultimately we are backing the entrepreneur and trusting the person with the money.
Sure, Ashish. Thanks. And the last one, what should be the expectation in terms of returns? If somebody invests in the Edelweiss Discovery Fund.
Sure. So I should I guess first as a disclaimer put out that I'm suggesting what I expect to deliver, but this is an expectation, not a guarantee. It is an equity investment, and the risk associated with it should be thought of as well. Given the 25 to 30% kind of operating growth and the multiplier effect of valuation, I think it would be reasonable to expect a range of 25 to 30% gross IRR as kind of the expectation that I would share. I hope to beat that, because obviously if you do the math of the 30% odd operating growth plus valuation arbitrage, if I can call it that, that return should be a lot higher. But I'm of course mindful that it's a portfolio approach and not everything goes to plan.
Thanks, Ashish. So I think we can conclude it here. Any concluding remarks from you?
No, thank you for your time. It's thanks to everyone for listening in to this. And if there are any follow-up questions, I'm sure there'll be avenues to have them addressed. I'll be happy to do a follow-up.
Sure, Ashish. Ladies and gentlemen, thank you for joining in to this webinar today. And if you get any questions that we've not been able to answer, or questions that may come to you subsequent to this webinar, please reach out to our sales team. We'll be more than happy to answer each and every question. And in case you feel that there is more clarity that you want and you would want to interact with our team and Ashish as well, we'll be more than happy to provide that access as well. So thank you for joining in. Have a nice evening. Have a good weekend. Thank you so much.